there is a real risk that the U.S. benchmark interest rates will rise to 6.5%. There are early days of concern that the economy may be overheating. It is possible that the most aggressive interest rate hike cycle since the 1980s, the Federal Reserve's benchmark interest rates of 5.25 to 5.5% has not yet ended. Due to the United States' strong growth and sticky inflation, the possibility that the central bank, the Federal Reserve, will raise interest rates rather than cut them has increased. There is also a warning that if economic expansion remains resilient and inflation remains above 2.5%, the Federal Reserve will resume raising interest rates early next year. And there is a risk that the federal funds rate could reach 6.5% by the middle of next year. Strategists also predicted that in the so-called no landing scenario of further interest rate hikes, the U.S. Treasury curve will flatten sharply and stock prices will fall by 10 to 15%. Previously, former U.S. Treasury Secretary Larry Summers advised to prepare for the risk that the Fed's next decision will be an interest rate increase rather than a rate cut. In addition, JPMorgan Chairman Jamie Dimon, known as the Emperor of Wall Street, stated in a shareholder letter that he was preparing for the risk of the U.S. interest rates rising to 8%. Recent U.S. economy indicators are showing surprising growth. Accordingly, the market has already reduced its bets on policy easing. UBS, a global investment bank, argued on April 15th local time that the U.S. Federal Reserve should raise interest rates, not cut them, and it was predicted that the U.S. base interest rates would soar to 6.5% next year. UBS issued a report today and assessed that the U.S. economy is experiencing strong growth and sticky inflation at the same time. So it is now necessary to raise interest rates rather than lower them. UBS is using two interest rate cuts this year as its basic scenario, but believes that if inflation fails to fall to the Fed's target, there is a growing possibility that interest rates will turn to hikes and a sharp sell-off of bonds and stocks will be triggered. The current base interest rate in the United States is in the range of 5.25% to 5.50%. This means that interest rates could rise by 1 percentage point compared to now. UBS strategists are still maintaining the stance that the Federal Reserve will cut interest rates twice within the year, but believes that if inflation does not fall to the Federal Reserve's target 2%, the Federal Reserve will have no choice but to switch to a policy of raising interest rates. If the Federal Reserve switches to an interest rate hikes, policy bonds and stocks are expected to plummet.